Imagine buying a house for $1. Not a foreclosure auction lowball bid, not a symbolic gesture in a legal document, one single dollar. And then nearly a decade later, you find out you might owe the IRS hundreds of thousands of dollars in capital gains tax on a home you technically paid almost nothing for. That is exactly the situation one New Jersey homeowner found herself in. And the answer to her tax question is both more complicated and more hopeful than she ever expected. This is a story about family, sacrifice, grief, and the hidden tax traps that can turn an act of love into a financial nightmare. But it is also a story about how understanding the tax code can save you from a disaster you never saw coming. Let us set the scene. 9 years ago, this woman lost her mother. In the middle of that grief, her elderly father made a decision that was equal parts practical and sentimental. He sold her the family home for $1. $1 so that she could become the legal owner, take on the responsibilities of a trustee, and ensure that he could continue living in the house he had shared with his wife for years. It was an arrangement born out of love and necessity, not tax planning. The father got to stay in his home. The daughter got legal control to manage the property and protect her father, and life moved forward. Fast forward 9 years. The father is now 83 years old. The house, which was probably already a valuable piece of New Jersey real estate, has appreciated significantly. It is now worth around $500,000. But here's where the problem begins. The house has stairs, not just a few steps up to a porch. We are talking about stairs just to get inside the front door, and then another full flight of stairs inside the home. For an 83-year-old man living alone, this is not just inconvenient. It is genuinely dangerous. A fall on those stairs could be life-altering or worse. The daughter, to her credit, has found a solution. There is a condo available right next to where she lives, on the first floor. No stairs, close enough that she can keep an eye on her father every single day. The plan is to sell the family home for $500,000 and use those proceeds to purchase the condo for her father. It is a thoughtful, loving plan. There is just one enormous question hanging over the whole thing. How much of that $500,000 is going to end up going to the government in capital gains taxes? And here is where her heart sank a little, because she bought the house for $1. So does that mean her entire gain is $499,999? Is she going to owe capital gains tax on essentially the full $500,000? Let us walk through this carefully, because the answer depends on something called the cost basis. And understanding cost basis is absolutely critical in a situation like this. When someone buys a property normally, their cost basis is what they paid for it. Simple enough. But when a property is transferred between family members for far below market value, the tax rules get more nuanced. The key question here is whether this transfer was actually a gift dressed up as a sale. And in the eyes of the IRS, a $1 transaction from a parent to a child almost certainly qualifies as a gift. The nominal dollar amount is what lawyers sometimes call a nominal consideration. It makes the deed transfer legally valid, but the IRS sees through it. Now here's where it gets really important. When you receive a gift of property, your cost basis is generally the same as the original donor's cost basis. This is called a carryover basis. So the critical number is not $1. It is whatever her parents originally paid for that house, plus any capital improvements they made over the years. If her parents bought the house in, say, the 1980s for $150,000, and spent another $20,000 on improvements over the years, then her carryover basis might be $170,000. That would make her taxable gain around $330,000, not $499,000. That is a massive difference. But wait, there's another layer here that could work significantly in her favor, and it involves the concept of a life estate or retained use arrangement. Remember, the father kept living in the home. The daughter did not move in. She was the legal owner on paper, but the father retained the right to use and occupy the property. Depending on how this arrangement was actually structured legally, there is an argument that this functions more like an inheritance arrangement than a simple gift. And that distinction matters enormously. If the arrangement was structured as a life estate, meaning the father retained legal rights to live there until his death, then there is a strong argument that the daughter does not fully inherit the property until the father passes away. In that case, she might be entitled to what is called a stepped-up basis at the time she fully inherits it. A stepped-up basis means her cost basis would reset to the fair market value of the home at the time of inheritance. If the home was worth, say, $400,000 when she technically came into full possession, her taxable gain on a $500,000 sale would be only $100,000. Now, this is not a guarantee. The exact tax treatment depends entirely on how the original deed was written, whether a formal life estate was created, how New Jersey law treats these arrangements, and a dozen other legal and factual details that only a qualified tax attorney or CPA could fully evaluate. There is also the New Jersey state tax dimension to consider. New Jersey does not conform to all federal tax rules, and it has its own capital gains tax structure. New Jersey taxes capital gains as ordinary income, which means depending on her total income for the year, she could be paying New Jersey state tax at rates ranging from roughly 5% on the low end to over 10% on higher income levels. This is on top of the federal capital gains tax, which for most middle-income earners is 15% on long-term gains and could be 20% for higher earners. Add in the 3.8% net investment income tax that kicks in above certain income thresholds, and you are potentially looking at a combined federal and state rate that could approach 30% or more in a worst-case scenario. There is one more possibility worth mentioning, and that is the primary residence exclusion under Section 121 of the tax code. Normally, if you live in a home for at least 2 of the last 5 years before selling it, you can exclude up to $250,000 of capital gains from taxation, or $500,000 for a married couple. However, in this case, the daughter did not live in the home, her father did. So unless there are very specific circumstances that bring this arrangement within the rules of a qualified use, the primary residence exclusion almost certainly does not apply here. So what does all of this mean practically? It means this family needs a tax professional before they sign anything, not after closing, not when the tax return is due, right now before the house goes on the market. They need a CPA or tax attorney who specializes in real estate transactions and estate planning, ideally someone who knows New Jersey law specifically. That professional needs to review the original deed from 9 years ago, understand the exact nature of the life estate or trust arrangement, calculate the true carryover basis based on what the parents originally paid, and map out the full federal and state tax picture before the sale closes. There are also potential strategies worth discussing with that professional. Installment sales, where the buyer pays over time, can spread the tax liability across multiple years. Qualified opportunity zone investments can defer and potentially reduce capital gains taxes if the proceeds are reinvested. And proper documentation of every capital improvement ever made to that home could meaningfully reduce the taxable gain. Here's the takeaway for anyone watching this. When property changes hands within a family, especially for nominal amounts, especially when the original owner continues living there, you are in complicated legal and tax territory. The emotional logic of what happened here is completely understandable. A daughter was trying to protect her elderly father and honor her mother's memory. But the tax consequences can be severe if you do not understand the rules before you act. Cost basis is everything. How the deed was written matters. The difference between a gift, a sale, a life estate, and an inheritance can mean the difference between a $100,000 tax bill and a $300,000 tax bill. And in New Jersey, where both federal and state taxes stack on top of each other, getting this wrong is extraordinarily expensive. The good news for this family is that with the right professional guidance, there are legitimate ways to minimize the damage. The situation is not hopeless. It just requires expert help immediately. If this has happened to you, if you have received property from a family member for $1 or inherited a home or are unsure about the tax consequences of a sale you are planning, please consult a licensed CPA or tax attorney before you do anything else. Do not guess. Do not rely on general information online. The stakes are simply too high. And if you found this video helpful, subscribe to this channel. We break down real tax situations that real people face every single day, so you can make smarter decisions before it costs you everything.